Hey, everybody, this is Russell Gray, co-host of the Real Estate Guys radio show with another edition of Boots on the Ground for August 2020. And in today's session, we're going to be talking about a really kind of esoteric tax break that real estate investors enjoy called cost segregation. And with us is our cost segregation correspondent, Erik Oliver. Hey, Erik.
Hey, how's it going, Russell?
Good, buddy. Really appreciate you being here. You know, this has really been a very exciting kind of technique or an aspect of real estate investing after the 2016 tax reform. It kind of really took off, and we've been enjoying this bonus depreciation, but that's coming to an end, isn't it?
Yeah, I think it probably is. I mean, we never know what's going to happen here in November, but my guess is that at some point this bonus depreciation will be axed and gotten rid of. So, how do we best strategize and look forward to that? How do we plan for that? I think the key is planning for it. It's going to happen at some point. Right now, the bonus depreciation is on the books until the 100% bonus is on the books till the end of 2022, assuming nothing changes between now and then. But yes, at some point, it's definitely going to go away. And how do we plan for that?
Yeah, we had Tom Wheelwright on the radio show a few weeks back, and he was talking about some of candidate Biden's potential tax proposals, and some of that was unwinding some of the things that the Trump administration pushed through. So again, we don't know what's going to happen, and we're not here to say that one candidate is better than another. We're just trying to look at the landscape and look at the possibilities and the probabilities. But we know for a fact, if nothing changes, then by the end of 2022 it goes away, and we know that you just can't run out and buy a big old apartment building tomorrow. So these are things that you start putting in motion in the next few months to be able to take advantage, make sure you get that full tax break even before it expires in 2022. Anything else changing that we need to know about in kind of this boots on the ground update that you're seeing in your space that people need to be aware of?
Sure. Yeah. And I listened to the Tom Wheelwright podcast, and I know he mentioned it, but I just want to reiterate the 5-year net operating loss carryback has been huge. We're seeing a lot of investors reaching out now as they're trying to generate cash flow. Maybe they have tenants who aren't able to pay their leases right now, whatnot. And so being able to utilize cost segregation to fully maximize those net operating losses. So if you've got real estate and you can do a cost segregation, create a massive depreciation expense, all of a sudden you've got a net operating loss. You can wipe out your current income and also go back up to 5 years and recoup taxes that you paid in previous years and basically get a refund from the federal government. So great way to generate cash flow during these tough economic times.
Yeah, I hadn't even thought of that. I'm glad I do these things with you. That's brilliant, right? I mean, if you're sitting there and you've got a tenant that can't pay, maybe you would like to, but you're having a cash flow problem, then what I hear you saying, Erik, is that you can take advantage of cost segregation on that particular property if you haven't already, or anywhere in your portfolio, and then reach back into the past and recoup taxes that you've already paid and get yourself a nice refund that actually puts cash in your pocket and supplements what you're not collecting in rent, right? That's basically what you're saying.
Exactly. Yeah. You can go back up to 2013. So the 5-year net operating loss was reinstated for 2018, 19, and 20. And so being able to, one, not have to pay taxes in the current year because you're going to wipe out your income for the current year, which is going to generate cash flow. But then also, instead of having to carry that forward, which you had to prior to the CARES Act, instead of carrying forward that excess deduction, the federal government now allows us to go back up to 5 years, recoup whatever taxes we were paying in previous years. And even if you weren't a real estate professional back in 2013, 14, 15, as long as you qualify as a real estate professional here in 19 or 20, you can then create that net operating loss and really enhance it by using the cost segregation studies, create that massive loss and go back and recoup taxes. Could be W-2 taxes. It could be taxes that were taxed at 39% at the old rates. So great opportunity. And we're seeing a lot of that through the investors we work with.
Wow, that's awesome. We were talking before we went on the mic, and I had asked you that maybe on some future episodes of Boots on the Ground that you come in with some case studies because I think that, seeing how, real investors are doing this in the real world and not just kind of talking about the hypothetical or the theoretical, I think is really interesting, especially when you can put some real numbers to it. Obviously you change the names and, you're not going to reveal any personal information. But I think
Right.
that would be really, really enlightening because, again, this is something that a lot of people just don't understand, don't pay attention to. But, if you really sit down and do the math, I mean, taxes are a big, big part of your operating expenses in anything that you do when you get to the bottom line, even with all the pass-throughs and when it comes to you, and ways to mitigate those taxes. I mean, using the code, right? We're not trying to get away from taxes that are owed. We're just trying to minimize or eliminate what is owed using the code that they've given us to do it.
Absolutely. Yeah, definitely. And the other thing we're seeing, Russ, too, with the CARES Act, I know, I believe Tom touched on this as well in the recent podcast, but the qualified improvement property, the changes that were made there, that was a change that was long overdue. They finally made it a 15-year asset. So what we've done is we've gone back and looked at all the cost seg studies we've done over the last couple of years, and anybody who had done improvements, interior improvements to a non-residential building, we've looked at opportunities there. So as investors, just even if you have done a cost seg study, if it's to a commercial property, definitely take a look at your study and see if it does qualify for the qualified improvement property. Because all of a sudden you're taking what could be hundreds of thousands of dollars and shifting it from a 39-year asset into a 15-year asset, which is now, after the CARES Act, bonus eligible, which means you get to write that off in the first year. So we're seeing we're looking back on all the studies we've done for commercial clients and saying, okay, does any of the improvements that you've done qualify as qualified improvement property? And if so, what is the additional deduction that you're eligible for?
Yeah. So, if you own I mean, how far down as far as buildings? I mean, obviously, single family home, probably not worth it, but
yeah.
At what point does this start to make sense for somebody?
$500,000 of improvements, it definitely makes sense. Even less than that, it does have to be non-residential. So it can't be an apartment building or single family home, duplex, anything like that. But any commercial building, whether it's medical space, if you're a dentist and you built out your medical space and you've got, $250,000, $500,000 of improvements, even if you had done a cost seg study, those improvements would have been classified into 39-year assets. Now with the recent change, a lot of those improvements can be reclassified as qualified improvement property, and now you get 100% bonus depreciation. You get to write them off in the current year here.
Wow, nice. So listen, if you just happen to stumble across this video and you're like, oh, cost segregation, I have no idea what these guys are talking about, but it sounds intriguing. You did a special report for us called The Benefits of Cost Segregation. And so I'll put a link to that in the show notes below, along with information on how to contact you in case someone, wants to ask, kind of personal questions. And then also put a link to the Tom Wheelwright podcast there, so that we referred to that a couple of times, so people can go back and listen. Okay, so so the tax code really hasn't changed. The economic environment has changed. The political winds of change are blowing, and we don't exactly know what that's going to look like, but it could impact the tax code. What else should be on our radar? Is there anything else you can look at from your viewpoint when you look at the world and based on the clients that you're talking to and the moves you see them making? And you can even go outside the cost segregation line. I mean, because I know that when you talk with people, they're people, and you have bigger conversations than just this little narrow box of cost seg. But what are you seeing out there as far as the way people's mood is? Are they optimistic about the future? Are they pessimistic? Are they making moves? Are they sitting tight? And if they are making moves, what kind of moves are they making? Are you seeing any type of insight at all into what experienced investors are doing in today's environment?
Yeah, that's a great question. I have heard a lot. I feel like a lot of people are trying to free up cash right now. I think most investors think that kind of this fall, next spring, there's going to be a lot of good opportunities to pick up some property at pretty inexpensive pricing. And so being able to set the groundwork now, get your cash ready, get your cash flow ready, set aside.
Get those big tax refunds.
Get those big tax refunds.
Get that money in your bank account, yeah.
Right, try to liquidate some of your assets so that you can take advantage of the, I think, I just can't remember the exact article or the exact numbers in the article, but they were talking about here locally, 190,000 people in the next 6 months are going to be real close, if not evicted, based on what they're studying and stuff. So there's going to be a lot of evictions. There's going to be a lot of short sale in terms of real estate. And so just getting your cash lined up, getting the groundwork now, because you don't want to have to be doing that when everyone else is making offers. You're trying to, you're a step behind the game if you don't have that stuff already lined up. So get it lined up now would be my recommendation.
Yeah, I mean, we've been talking about that quite a bit on the show. I think, take the equity out of the property while it's still there, either by selling the marginal properties or refinancing the keepers, lock in the rates for the long term. Wouldn't take a risk on adjustable rates in today's environment. I would not be out there bidding on things at top of market, even if you got to pay a little bit to float the cash. You probably more than make up whatever that expense is. I'm going to ask one last question, then we're going to kind of wrap this thing up. And
Sure.
that is that, if somebody's already kind of taken bonus depreciation, they've kind of used it up on a current property. Does it make sense, for them to maybe think about getting rid of that property and getting a different property where they could pick up a new depreciation schedule, a new bonus depreciation schedule, and then go back in those 5 years and pull back some more taxes from the past?
Yeah, absolutely. Yeah, that's a strategy we see quite often. Investors, they'll hold it, before the bonus depreciation, they would basically hold it 3 to 5 years, maximize the 5-year assets, and then sell it and go get a new property and just keep playing that game where you buy, sell, use the depreciation, sell it, get a new property, use the depreciation, because it's one of the most powerful tools in offsetting income and offsetting tax liabilities. So
well, yeah, and
again,
you basically are going back in the past, and what the way I would view it is I'm going to go in the past and regain the taxes that I paid and use them for down payments going forward. And if I'm jettisoning marginal properties in my portfolio, which I need to clean up anyway, and then adding new properties, I can maybe add new properties in better markets, plus pull some cash from the past into the present. Right. Now I've fortified my portfolio. I've increased perhaps some liquidity because I don't have to deploy all my cash. And then I've put myself in a position to weather the storm better because the marginal properties are no longer in the portfolio.
Right. No, that's great strategy. Great point.
Yeah, love it. Okay, well, very stimulating. I have to be honest with you. When I saw this on my schedule, I go, oh, yeah, cost segregation is what's changed since last time. But this turned out to be really interesting. So thank you so much, Erik. Really appreciate it. Any closing thoughts?
No, I think right now timing is key. Like you said, there's a lot of uncertainties out there, and what's the old saying? Bird in the hand is better than 2 birds in the bush. So take advantage of the tax law the way they are now. You might forego a few tax dollars in the future, depending on what happens, but there's so much uncertainty that I just think take advantage of it while we can. It's kind of my last thought there.
Yeah, absolutely. Couldn't agree more. Okay, buddy. Well, Erik, I really appreciate the time and look forward to visiting and maybe checking out a couple of your case studies going forward.
Sounds good.
All right.
Thanks,
Take
Russell.
care.
Take care.
Right.
Have a good one. Bye-bye.
Bye-bye.